Hey everyone, so have you ever wondered how to be a quant investor? So as an investment actuary with over 10 years investment research experience, I've seen my fair share of investment strategies. So join me, because in this video I'm going to run through the different types of quant investing and how it differs from qualitative or discretionary investing. So let's get into it. So you may have heard of a type of investing called charting, which is where investors look for particular patterns within price history. And this is kind of the opposite of fundamental investing, where you ignore prices and just look at kind of the fundamentals of the investment you're making. Charting is looking at only the price history. It's looking for patterns in those price history. And the theory is that those patterns repeat themselves over time. So if you spot that pattern, you can position for it and profit. So the problem with doing this on a qualitative basis is that humans had to, one, learn all the patterns, and then two, identify them in the market and position for them. This was extremely inefficient, and humans would often miss the pattern, they would second guess themselves, they would react emotionally to historic losses or gains, and this just made the whole thing very ineffective. Also, early on in the financial markets, lots of complicated derivatives were being developed, and no one really knew how to price these, so no one knew what the fair price of an option was, for example. The human investors would just apply their subjective judgment and aim to profit that way. The problem with this is it had all the biases that humans have involved, and also they were subjected to their emotions like fear and greed. So to help overcome all these issues with human investors or qualitative investing, quants entered the stage. And quants typically used mathematical formulas to price these complicated financial securities, and they also used computers to help crunch the numbers and invest. So some famous quant investors you might have heard of, so Cliff Asness from AQR, Ken Griffin from Citadel, and of course Jim Simons from Renaissance Technologies. And Jim Simons actually is very famous because he has one of the best track records of all time. I think he analysed something like 30% over 20 years. So very impressive track record. And so it shows that you can make huge amounts of money in this area if you know what you're doing. And these investors employed quant strategies, so using computers and mathematical formulas to make money. Some popular types of quant strategies are stat arb. So statistical arbitrage basically looks for patterns between individual equities and positions for those. And trend following is another common quant strategy where moving average crossovers, so different periods of moving averages, when they cross over, investors typically go long or short a particular market. And trend following obviously is there to profit from the fact that markets that are going up tend to go up for a bit more, and markets that are going down tend to go down for a bit longer. So trend following makes money because markets tend to go up if they've been going up in the past, and they tend to go down if they've been going down in the past. And that obviously directly contradicts the efficient market hypothesis, which says that the future direction of the stock has no relation to its historical direction. So if you moved from being a qualitative or discretionary investor to a quant investor, how might your strategy change? Well, the first thing is that you'll be primarily driven by data. So qualitative investors might use qualitative factors in their investment decisions. So they might be heavily influenced by a conversation with the company management, for example, which is really hard to quantify, but still provides some sort of information. But quant investors would ignore all that, and they would only program into their computer the quant factors that they can get cold hard data for. This has benefits and drawbacks, I guess. So benefits are that like you're not skewed by a lot of your emotions and behavioral biases, but the drawbacks are obviously not everything that's important can be quantified and fed into a computer, so you might be missing some valuable information. So the second way your strategy might be transformed is it would be systematic and rules-based. So human investors obviously use a lot of discretion on entry points, exit points, what to buy, what to sell. And quant investors would program all this into specific rules. So a classic example of this might be some sort of stop loss where you automatically cut your position if you draw down more than 2%. And obviously some of the strategies I mentioned before use statistical rules. So the moving average crossover, for example, in trend following, this is a statistical rule that can be programmed into a computer that it will follow over time. So yeah, you would be very systematic and rules-based as opposed to judgment-based. I guess the benefits of this are that it, again, gets around human emotion, fear and greed, definitely this helps with. That's what stop losses are for, helps investors cut their losses when they obviously don't want to cut their losses. That's part of loss aversion. The downsides are, I guess, lack of flexibility. So you might be entering different market environments, you might have extreme high conviction on a trade and might not want to get out, but the rules are there kind of limiting your freedom, individual positions. So the third way your investing strategy might be transformed is there's no emotion. So I mentioned that before. There's no fear and greed in a computer system, it just runs. And that can make things pretty hairy if you're a quant investor, because you might be watching your trading strategy and it might be making loads of money and you might want to size it up, or you might be losing loads of money and you might be wanting to cut back, but the whole idea of quant investing is you just trust the models and let it run. In The Man Who Solved the Market, the book on Jim Simons, obviously the legendary quant investor, there's an example where Medallion was losing a lot of money and they had this kind of big discussion about whether or not they would cut risk or just let the model run. And that's just a constant, even in my professional day job, like when we were quant investing, a common topic of debate was just when do we cut versus when do we let the model run. The purist quant investors would say just let the model run and trust the model. Point number 4 would be that quant strategies are extremely scalable. So the patterns that quant investors typically identify can be observed in all different markets. The markets just need to be liquid and have good price history. So obviously one type of trading strategy could trade multiple markets and that wouldn't require you to hire extra people. If you wanted a discretionary trader on it, like lots of different markets, you probably need one trader per market so they can follow it closely, but quants can just do that themselves. But quant investors would have computers that could search all markets for pricing anomalies and identify opportunities to invest. And element number 5 is that computer-based trading strategies would be very fast. You might have heard of high frequency trading. They can trade so much quicker and be in and out way faster than any human investor. So that might mean that there's more opportunities available to them. Although the talk in the market now is that these strategies all kind of cancel each other out and there's no real competitive advantage to speed anymore. But that was a big push in the early days of quant investing. So there we have it. If you want to transition to be more of a quant investor than more of a discretionary investor, there's some elements of how to do it. So you need to be quite good at computers and calculations, so maths, but it's obviously there for the taking. From my experience, quant investing nicely complements discretionary investing. They're two quite different return profiles. So I wouldn't say one is better than the other. So I hope you enjoyed this video. If you want to hear more from me, don't forget to check out this one here. Thanks.